Alrighty then. Welcome to a very special episode of Real Iraeta. Today I'm here joined with a very special guest, my father. This is Brigham Iraeta. He's it's a Father's Day special of sorts, you could say, because my father is here, and he's a very smart man. He knows just about everything I know because he taught me everything I know. So
Not everything, definitely not everything.
um,
I'm here to learn a lot too.
Yeah. So I mean, you could tell my audience about yourself and yeah, just what exactly you do.
Yeah, so I am the proud father of Elijah, as he has already said. I work in the tech uh, industry, if you will, the tech segment for a company doing something very interesting with auto insurance, a little bit like Uber to auto insurance. But I've done a lot of things. I've been in direct selling for a long time. I've also done a little bit of work with life insurance for a few years. I love finances. I think it's really important for everybody to understand how money works, how understand not only how money works, but how you can work for you. Use it to your benefit. Doesn't mean that we're always good at managing money, because sometimes we want things
Yeah,
and we
that's true.
and we spend money on stupid stuff. But
And I'm sure my dad could tell you how much money I spend on very useless crap.
hey, as long as as long as you can do it. One day you won't be able to. One day you'll have to buy diapers and things like that, and then
Yeah.
so enjoy it while you can.
Yeah, for sure. And it's very good that he knows a thing or two about finance because today I have a very interesting story lined up for us today. So I want to talk about today this sort of AI gamble that we see a lot of big tech companies are putting into, well, I guess the market. So we see big companies like we have Amazon, Meta, Nvidia, they're all making this very large bet on AI. And some are even saying that this could potentially be a bubble that is as large or even as larger than the 2008 real estate bubble. And so we will talk a little bit about that today. It's a fantastic story. I think it's a lot of great discussion points. So without further ado, I'll just get into explaining a little bit. So something that needs to be understood first is private credit. So private credit is for those who don't know, is lending done outside of traditional banks and public bond markets. So instead of going to like JP Morgan uh, for a loan or issuing publicly traded bonds, companies that borrow directly from private funds, firms like Blue Owl Capital, who we will discuss later, Apollo Global Management, Blackstone, PIMCO, and BlackRock. And at its core, asset managers are going to raise more money from investors and pool it into funds and then they'll use that capital to loan out to other businesses, generally charging higher interest rates in exchange for taking on more risk. And now this market has nearly exploded. Private credit is nearly at a $2 trillion market in the United States alone. A decade ago, it was roughly about 500 billion, and it's quadrupled in size in 10 years. And the Financial Stability Board puts global private credit assets at an estimated 1.5 to 2 trillion, noting that it has expanded rapidly while creating potential financial stability risks. And I'm not sure if you, about any feelings you have towards private credit or any thoughts about private credit.
No, I think that when it gets scary is when so many institutions are taking so much risk with so much money, because when things happen and things go wrong, they're always looking for somebody to bail them out. And who does that fall under? Usually, the government, right? Which eventually just comes to us in some form of another, whether it's more debt or taxes, and so that always makes you nervous. Compared to, again, what we saw in 2008, there was a lot of bailouts, and back then the bailouts were only like $700 billion, not even a trillion, right?
Yeah.
And we're playing with companies that are worth multiple trillions. It can be a little unnerving.
For sure. And we'll go through a lot of those more in a bit about these bailouts. But an important thing to understand about private credit is where this money actually comes from. And this is the most important thing you guys need to understand about private credit. So some of the money that the private credit gets, it comes from institutional investors. So pension funds, insurance companies, and sovereign wealth funds are primary drivers, and they contribute more than half of all capital raised in private credit. And most private credit funds are only available to institutional investors, pension funds, and insurance companies. These are not billionaires gambling with personal money. This is teachers' retirement funds, firefighters' pensions, and life insurance policies that are held by ordinary Americans. So, lenders like Blue Owl Capital and Apollo raise money from pension funds, endowments, and insurance companies that can afford to make these risky bets in hopes for big returns. And it's getting closer to retail investors. In August of 2025, President Trump actually signed an executive order aimed at encouraging more alternative investments in 401ks, which includes private credit. A formal proposal from the Labor Department is pending. If that goes through, everyday Americans' retirement accounts will become directly exposed. And in early 2026, Blue Owl limited withdrawals from its retail debt fund, and that's aimed at non-professional investors that the private credit market is increasingly trying to attract. And a firm that just did a $30 billion deal with Meta is simultaneously capping redemptions for retail investors. And that is a detail that's very worth to sit with. And something I bet people are wondering is how it can grow so fast. And after 2008, regulators cracked down on bank lending. Capital requirements went up. Risky loans became harder for traditional banks to actually make, and private credit funds stepped in to fill that void, operating largely outside the regulatory framework that governs banks. And following these regulatory reforms, corporate lending shifted from deposit funded banks to institutional investors, and non-bank institutional investors continue to replace these deposit funded banks as the primary source for capital for corporate lending. And Jamie Dimon, who is the CEO of JP Morgan Chase, he put it directly to a Senate committee. He's saying, quote, as lending activity moves away from regulated markets, the likelihood increases that risks go unseen, end quote. The man who runs the biggest bank in America told Congress that the shadow banking system is flying blind. That is the quote. And you, unlike me, were actually, well, I was around for the 2008 bubble burst, but I was certainly not.
You were just
conscious.
a baby.
I was just a baby.
Just a brand new baby.
I was not conscious enough to even know. So I mean, you could just talk about what it was like to actually live through that experience, going through the real estate bubble as just your average American citizen.
Yeah, no, it was interesting. I had a lot of friends that had bought homes just like right before this whole thing happened, and they bought at a way high price because it seemed like houses are gonna keep climbing in price. It was just you're gonna be able to buy a home and 2 years later sell it for twice the price. And it was wild, and something definitely felt wrong. There were areas where people were buying homes, and the types of homes they were buying that you were thinking, holy cow, I wouldn't pay that much for that house, or in that area you're paying that much for the house in that area. Just some things that didn't quite click. So that portion of it obviously was a little worrisome, and it felt like at some point it has to stop. And when it did, it was really scary. But I think the worst part of it all was the tremendous job loss that happened as a result of the crash. Yes, a lot of the economy crashed and all these things, but the biggest and scariest thing is just at the speed at which people were losing jobs. Obviously because of that, people lose their homes, and it's just kind of like a domino effect of all these different things that keep happening. So it was not a fun time. And but just like with everything, hard times can open up good opportunities for certain people if you're in the right spot.
Mm-hmm.
That the whole thing that happened allowed us to buy our first home for very, very cheap.
Yeah. And of course, as I go through some of this information, feel free to stop me and be like, well, this is what I think, or if you have a thought, feel free to add on. I mean, this is why you're here.
Okay. We'll do that.
Okay. And so with that being said, something that we have to consider is this artificial intelligence spending machine. So the scale of what's being built and how it's being financed, and these are the raw numbers we're looking at here. So Amazon is planning for about $200 billion in capital expenditures for 2026, and Alphabet revealed plans to spend $185 billion. The four major hyperscalers, Amazon, Alphabet, Microsoft, and Meta, have already lost over 950 billion in combined market value since dropping their latest earnings and spendings forecasts. Morgan Stanley expects 250 to 300 billion of debt issuance in 2026 from just the hyperscalers and related joint ventures of these building computing capacities. And AI-related companies and projects tapped debt markets for at least 200 billion in 2025, and that's likely a significant undercount, as many deals are actually, in fact, private. And the total estimate price tag to build the data centers infrastructure that's going to be needed for the AI boom is estimated to be about 3 trillion, and that's a massive number. And by one estimate, around 1.5 trillion in external financing is needed across the AI ecosystem by 2028 to bridge the gap between cash flows and capital expenditures.
And I think that's where a lot of people get so nervous right now. It's you're talking about these hundreds of billions of dollars,
Mm-hmm.
right? Like they're moving across, just across the markets. And when you think about that much money, if investors get into them, let's say there's a movie called The Other Guys, pretty funny movie. But the premise of it is that at the end of it, there was a guy that was trying to have this Ponzi scheme, and the police department's chair that was in charge of the 401k was about to invest into this scam. Essentially, they had discussed it as this real estate development, but it was a scam. And so when people hear this much money moving around, they start thinking like, is my 401k going to end up in some of those investments? Is my 401k going to end up taking a tank if some of this goes down, because it is a lot of money. And so I think that's what makes people nervous, just how much money is floating around, just throwing around hundreds of billions of dollars.
Mm-hmm.
Like I remember when I was in my mid-20s, and YouTube got bought for $1 billion.
Yeah,
it just seemed like all this money, just like it was so hard to comprehend. Like $1 billion, somebody paid $1 billion for a company. And then nowadays, a company gets sold for $1 billion, and you're like, oh, well, that's cute. Oh, good job.
I was like, oh, what a deal.
Yeah, like, hey, good on you, $1 billion. Hey, yeah. So, anyways, I think that's why so many people get so nervous. There's so much money to think about. 200 billion, 500 billion.
And it's also an interesting point when you consider companies like SpaceX, who've recently just went public, and there was actually a bit of rule changes surrounding SpaceX IPO, where they're just trying to find places to put some of this money, and we're changing around some of the rules to actually start putting SpaceX stock into some pension funds and some 401ks to actually put these people who put their money into these funds towards SpaceX. And some people were a bit nervous about that, because they were like, well, I'm not sure I want SpaceX in my 401k or my pension fund, simply because they trade about like almost 90 times what their revenue is, and that makes some people very uncomfortable. So it's just another interesting point when you consider just about how much money is moving around in these markets. It's a ton of money, and especially compared to back in 2008, when some of these numbers weren't quite as large.
Yeah, no, it's so true. And again, you talk about 94 times earnings. SpaceX hasn't been like a huge, as far as profits go, SpaceX hasn't been a hugely profitable company. So again, I'm not an investment expert or anything like that, but I just think something doesn't make sense, something doesn't click, right? Like there's gotta be an adjustment at some point. And when an adjustment happens, it's half of my pension, right? Or half of my investment is gonna be tied to all of this stock, so it's gonna adjust, and then there's nothing you can do.
Yeah,
like the market, they said that the market gives you the real value of a stock at any point, right? It's like the theory that at any point the market is reflecting accurately the value of the stock. But what if the market decides that, yeah, no, it wasn't this much, it was really this much, and it's not going to go back up here anymore, right? It's just going to stay right there. There's no way for you to make your money back.
Yeah, it's just really interesting to see like because I mean, sometimes obviously it's not uncommon for companies to trade at a certain multiple above what their revenue actually is. Like for Nvidia, for example, they do tend to trade at a certain multiple. I'm not sure what that number is off the top of my head, but they do trade above what their revenue makes. But a lot of these companies do have really good cash flow, and if you most people in the investment space would know that cash flow is king. It is the blood of a company. So, and oftentimes research companies or more scientific companies like SpaceX, except SpaceX doesn't fall under this category, but a lot of them actually operate at a net loss. The research companies like biotech companies, they don't actually make money.
They just spend it.
Yeah, they just spend the money in places where they need to get this research done. So usually it's these outside companies that come in and put money into these companies to further their research. And usually when they find something good, their stock price goes boom, because there's a lot of these biotech companies that do end up being publicly traded.
Yeah.
So just another interesting thought.
They get one good medication, one good treatment out of it, and it can be worth multiple of whatever they spent into it.
Mm-hmm.
So,
and this is the thing about these companies, is that these companies aren't actually spending money on these I guess you could say these endeavors, these AI endeavors, and these AI experiments. So, for example, Microsoft, Meta, and Alphabet are expected to generate negative free cash flow of up to $28 billion in 2026. Both Alphabet and Meta are expected to see free cash flows drop by roughly 90% in 2026. Cash reserves are also rapidly dwindling. So these companies have cash, but the issue is that the scale of spending is outrunning even their enormous cash generation. So they borrow, and how they borrow is our story today. And to avoid over leveraging their corporate balance sheets, hyperscalers often partner with developers who build and own data centers through SPVs or special purpose vehicles. The debt goes into these SPVs, and the company's balance sheet will actually stay clean. And then investors are now worried that the biggest tech companies will keep borrowing until it hurts in the battle to develop the most powerful AI. And the fear is breathing new life into the market for these credit derivatives and financial instruments that allow banks and investors to protect themselves against borrowing, taking on too much debt. And credit derivatives on big tech didn't even exist a year ago, and now there's some of the most actively traded contracts in the U.S. market outside of the financial sector. So I'm just going to say that one more time. The financial industry is now hedging against the possibility that big tech defaults.
Which is scary, right? These are the guys they're the experts at trying to see into the future. Like that's so much of their job and their success depends on trying to see into the future.
Mm-hmm.
And so if they're going, yeah, we want you to do it, but we're thinking that maybe we should be prepared just in case you don't, shows you how volatile it actually is.
Mm-hmm. And that's and for those who don't know, that's the whole point of a financial company, like a hedge fund. Hedge funds, they are sort of like these really fancy funds where only specific people, such as very rich people, because you have to have a specific sort of net worth to actually get your money into these funds. But hedge funds, they play both sides of the market. They'll buy stocks, or they'll short certain stocks. They'll do everything they possibly can to stay ahead of the market. And typically these hedge funds performance or their success can be compared to the returns of, say, the S&P 500. And if a hedge fund is outperforming the S&P 500 in matters of percentage and returns, that usually means it's a very good hedge fund. But it is a very, very hard thing to do. So usually the S&P 500 is just really good at making these really good returns, because the S&P 500 is the collection of the biggest 500 companies in the United States.
Yeah.
And so if these hedge funds are now starting to, as we mentioned, hedge out they're hedging their stocks and their positions in the situation where these companies default or they crash. It's a very considerable detail to keep in mind when you're thinking about people or these discussions where people are asking if this is an AI bubble we're in the middle of.
Yeah, and again, they're not, a default, right? A crash by some of these companies. Again, this is where the risk and the fear comes from is that we're not dealing with $5 billion companies anymore. We're not dealing with $10 billion companies anymore. This is multiple hundreds of billions of dollars, and that's a lot of market value to take out. When that much money is lost out of the market, somebody's going to have to suffer. Somebody's going to lose a lot of money, and the problem is that the the institutions, they just go get more money, right?
Mhm.
They'll go to the central bank, they'll go to all their private investors, just get more money to continue up. But what happens when the neighbor, right, or you yourself, maybe you're 10 years away from retirement, and now your 401k or your Roth IRA loses 50% of its value, 40% of its value, and now what you thought you're going to have for retirement is only half of that,
Yeah,
right? You thought you had $500,000 in the bank. No, you don't. Now you only have $200,000. That changes your life immediately because now you don't have enough money to last you what you were hoping for.
mhm,
And so, anyway, so that's another thing that really worries people when they see a volatility in a company that can create that kind of a hit into the market.
for sure. And I suppose the next important thing we have to think about here is this deal that I previously mentioned with Meta. So in October of 2025, Meta Platforms and the private credit firm that I mentioned previously, Blue Owl Capital, they closed it was $30 billion financing deal for the Hyperion Data Center campus in Richland Parish, Louisiana. It's the largest private credit transaction ever executed, and it didn't just fund another hyperscale build. It actually redefined how America may finance the $1 trillion AI infrastructure boom. So the structure of this deal was Morgan Stanley set up a SPV called Beignet Investor. Blue Owl owns about 80% of this SPV, and Meta owns 20%. The SPV issued $27 billion in debt, anchored by PIMCO, which is another private credit firm, which was about $18 billion, and BlackRock had about $3 billion involved as well, and plus a $2.5 billion in equity from Blue Owl. So this total deal ended up being around 27 billion. And Meta will not directly borrow the funds. The financing is executed through this SPV, with Meta serving as a developer, an operator, and a tenant once the site is completed to expected in 2029. And so what that basically means is just that Meta doesn't even own this building. Blue Owl owns the building, and Meta pays the rent. The rent payments are structured to service the $27 billion in debt. So Meta has the economic obligation or the lease commitment, but not the debt on its books. The liability is real, but in the balance sheet is going to say otherwise. And instead of issuing corporate debt directly, the company leases the finished facility from the SPV records, and the records as the payment and as rent rather than interest. And on paper, the leverage disappears, but the obligation is going to remain. And the difference lies in accounting visibility. So the debt will sit inside the SPV, not on Meta's balance sheet. Morgan Stanley projects that about $800 billion in off balance sheet financing will be needed by 2028 across the AI sector. So that includes Meta and all these other massive tech companies like you'd see in the Magnificent Seven.
And so people might think, well, why does that matter? Like, why, who cares if they finance it, how they finance it? And the reason is because just like with any other company, it all depends on your balance sheet, right?
Mhm.
And then if you're heavy on debt and little on cash flow, your stock isn't worth quite as much.
Mhm.
But if all of a sudden this debt goes away, right, on paper, you're a more valuable company. But in reality, the company still has the same risks.
Yeah.
But they're making you think that it's not. So then the stock is worth more. And so it's a pretty cunning way of, creating more value out of a stock that maybe shouldn't be worth as much.
Yeah, and it's a thing that's definitely tricky for people like retail investors who aren't necessarily super knowledgeable in the
Yeah.
financial space. Like they might be able to read a balance sheet, but maybe not know enough to go as far as to read into some of these sort of stories or these obscure credit derivatives like an SPV to actually understand that maybe they're not, maybe like they do actually have a lot of debt, but you just can't see it because it's not on their balance sheet.
Yeah.
And that affects those kind of people directly.
Yeah. Imagine you had a neighbor and the neighbor says, hey, I need you, I would like you to invest $10,000 into my company. Right? I'm starting a business. I can $10,000, and you go, okay, well, let me see your numbers. Let me see your balance sheet. And you go, oh my gosh. So you're spending, you're going to spend $3,000 over here, and but you're going to be making, $10,000 a month, and you go, yeah, it sounds like I'm going to get my money pretty back. I mean, I'm going to get my money back pretty quick.
Yeah.
Right. But then it was like, yeah, financials look great, don't they? You go, yeah, it really looks great. But they didn't tell you, right, that a part of their expense that they were going to have to do, it was like the building. And the building was $4,000, right? Like, it was $4,000. And all of a sudden, yeah, he's not making, $7,000 a month, right? He's only making $3,000 a month. So now you get your money back, maybe, right? And if you do, it's going to be a lot slower.
Mm-hmm.
And so, had you known that he had this other rent payment in some other way, right? If you had known, you might have not loaned him the money. You say, no, you over leveraged. It's just not a good bet for me.
For sure.
And so it is a really cunning way of doing it. I wasn't even aware that they were doing this.
Mm-hmm, yeah. Creativity in the finance industry can get you places. You can make a pretty good creative model, like a fancy discounted cash flow model or something. You'll get some praise, but if you're creative in accounting, you might go to jail.
Yeah.
So it's just one of those funny things. But Meta, in its SEC filing, actually named Blue Owl Capital as its partner. And this was the first major SEC filing to explicitly disclose this type of SPV arrangement with a named private credit firm, which is why it drew so much attention. And before that, these deals were structured quietly, and Meta made it visible. So this Hyperion campus will be 4 million square feet, 2 to 5 gigawatts of power capacity on 2,250 acres of former Louisiana farmland, and it is set to be completed in 2029. If AI demand collapses before 2029, the facility isn't built yet, and the debt is already deployed. And there's a bit of a parallel here with the company Oracle. And Oracle has actually constructed numerous data centers through SPVs, and these off-balance sheet arrangements include approximately $13 billion invested by Blue Owl and JP Morgan into an SPV that owns Oracle's OpenAI facility in Abilene, Texas, a $38 billion debt package funding 2 data centers in Texas and Wisconsin, and an $18 billion loan financing in a site in New Mexico. Oracle alone has over $69 billion in SPV-related off-balance sheet data center financing. Meta's deal is the most famous, but it's not the biggest in aggregate. And with that, there is a bank called the Bank for International Settlements. And for those who don't know, this is basically it's the most centralist bank. Even the Federal Reserve, who is like America's central bank, or is America's central bank, answers to the BIS, or the Bank for International Settlements. And they coordinate the world's central banks, as I just said. And when the BIS speaks about financial stability, it is not a fringe warning. It is the most credentialed voice in global finance outside of individual central banks themselves. In March 2026, BIS official Egemen Aaron, Ingomar Krohn, and Karamfil Todorov, they all formally published a note saying that these SPV arrangements, quote, amount to shadow borrowing obligations that are economically akin to debt, but largely reside outside corporate balance sheets, end quote. And the BIS also said, quote, by channeling sizable private credit into AI infrastructure, these structures strengthen links between hyperscalers and non-bank investors, such as private credit vehicles and insurers. Banks support the vehicles with funding lines, potentially creating new shock transmission channels via refinancing pressures at the vehicle level, pro-cyclical shifts in private credit appetite, or the activation of guarantees, end quote. So that's a lot of really, it's loaded with all sorts of words that to the average viewer, and even a little bit of myself until I did the research for this, meant nothing.
Yeah, same to me.
So basically, translated into English, if one part of the system gets stressed, if AI demand disappoints, and if interest rates rise, If a major private credit fund hits liquidity problems, the shock does not stay contained. It's going to travel. Banks are connected to the SPVs, and the SPVs are connected to private credit funds, and these private credit funds are connected to pensions and insurance companies. And insurance companies are connected to every American who has a life insurance policy or an annuity. The BIS warning specifically flagged that off the balance sheet debt is, quote, increasing the exposure of insurers and private credit funds to hyperscalers, end quote. The people holding the risk at the end of the day are not tech companies, they're institutions that hold everyday Americans' savings. The BIS March 2026 quarterly review noted that hyperscalers' gross bond issuance topped 100 billion in 2025 alone, and that these expenditures have grown significantly beyond their usual investments. A rising share of spending is funded through these off-balance sheet arrangements. So the Financial Stability Board added on to this, and the Financial Stability Board is an international body that monitors the global financial system. They also issued a sort of formal warning in May of 2026 that the private credit sector complexity, leverage, and interconnectedness could amplify stress in adverse scenarios, posing broader risks to financial stability. Yeah.
Yeah.
Or just say,
Yeah, it's I mean, it just is right there. It's a domino. Right, there's so many things that can go wrong that can set off the banks, right, the institutions, the pensions, people's savings, people's livelihood. And so there's a lot of let's just say that this sentiment that people have, or they're a little bit hesitant, is not unfounded. And I don't, even though people may not be able to express how they're feeling or why they're feeling it, I think that deep down, just in their gut, in their check, they can feel the weight of that one domino that can AI is that main domino, right?
Mm-hmm.
Falls over, is going to take a lot of other dominoes down with it.
For sure. And the FSB report that was published within the same month noted that private credit has expanded rapidly to an estimated 1.5 to 2 trillion in assets, supporting financing for mid-sized companies, but creating potential financial stability risks. And the timing on this is going to matter because both the BIS and the FSB issued formal warnings within 2 months of each other in early 2026. That is not coincidence. These institutions are watching the same thing, and they're trying to put it on the public record. They're trying to keep it in, or put it into people's minds, essentially, even though some of these reports that come out are filled with all sorts of, I guess you could say, jargon or technical terms that are not usually known by the regular public. But luckily for people or for journalists like myself, that's why we're here, to sort of help explain some of these large, chunky reports or documents that make no sense to someone who isn't in that space, to someone that does not know.
Yeah, and it's nice to be able to have somebody that can explain the parts that matter and figure out the language, like earlier, right? It went over a lot of our heads probably, but to have somebody explain it, break it down to bite-sized pieces, or like you like to do is, okay, why should I care? Why does that matter to me? Because at the end of it all, that's what I want to know.
Mm-hmm.
Right?
And another very important fact to consider here is there's a lot of cracks in the private credit market right now, and there's already some signs of stress that are showing right now. So, for example, BlackRock's business development company, BlackRock TCP Capital, it surprised its investors when it disclosed a 19% decline in the net asset value of its investments. The fund had blamed write-downs on poor performance in Q4 of 2025. But the fund's managers had marked most of the same investments at or near costs in financial releases as recently as November. And according to Wall Street Journal analysis, in other words, the losses were already there. They were just not being reported accurately. And this valuation lag is structural, not accidental. Private credit funds typically report net asset values within a 60 to 90-day lag and use model-based rather than market-based valuations. And during stress episodes, public credit spreads, they widen months before private equity marks adjust, creating a valuation gap that understates realized losses and delays capital calls from insurer limited partners. The system is designed to know what things are worth until it's too late. And in Q1 of 2026, Cliffwater, which manages about a $33 billion flagship private credit fund was asked to tender about 14% of its shares by investors wanting out. It responded by imposing a 7% cap on shares being tendered. Morgan Stanley did the same with a semi liquid retail oriented fund. And that just means that people tried to pull out their money and couldn't get it all back.
That seems unfair, doesn't it?
Yeah.
That's like, no, like you're paying with that's my money. Like, yeah, I gave it to you, but that's my money. And you're being so risky and you're not really investing according to my values. So I want my money. And they're like, all right, you can have your money, right? Or you can have it, but according to my rules. Like,
Yeah.
Because I need as much of your money for as long as I can. So I'm only going to let you, get 7% at a time. And that, I mean, yeah, that it really seems unfair, but it shows you kind of who has the power, right? Who holds the power. And again, the reason why it's so important to be well versed financially. Just you gotta be able to know how everything works, but enough for you to know that, hey, look, if they're gonna tie up your money, maybe look into their their terms and conditions. What's there that is not for your benefit. Maybe there's a different fund that you go and invest in, or a different company. But anyways, yeah, it's really important for people to understand that it's not enough to just give your money to Vanguard or to whatever company this was. It's not enough, because they can still screw you over.
Yeah, and that's another major part of the story, is that this story not only involves the possibility of this AI boom being a possible bubble, but it also highlights sort of the credibility of some of these very large banks, because a lot of Americans, average Americans who are just trying to grow their money towards retirement, they give their money to these banks and expect them to just do the hard part, which is actually growing the money. And
they make a lot of money doing that, right?
Yeah, they do. That's how they make a lot of their money.
They get a chunk, percentage of usually of whatever they so, which is why they do it, right? So they get a percentage of whatever they're managing for you. So the more the money is worth, the more their percentage is worth. It's not the same to charge 1% to 1,000, or charging 1% on a billion. And so yeah, it isn't their interest, to make it bigger, but yeah, that's how they get paid. Is they get a portion of your money.
Yeah, and sort of as another point to mention, private credit default rates in the U.S. hit a record of 9.2% in 2025, according to Fitch, and that is historically high, a high default rate for an asset class that was being sold to investors as relatively safe.
Yeah,
and Morgan Stanley projects that private credit default rates will be hitting 8% going forward. Insurance companies reportedly hold 8% of their assets in private credit. A March 2026 study actually found that while many private credit funds that they use little to or no leverage, some rely on bank funding, creating spillover channels to the broader financial system. And of course, bank funding usually means people's savings that they put into these banks, because that's, if you've taken a financial literacy class before, that's what a lot of banks do when people need are looking for their money back. Some of these things, they have to pull from your savings, and of course, well, it doesn't look like your money's been pulled here. If you check your bank app, that money that you actually put in is not there. And of course, if you ask for their money, they're going to probably ask for someone else's money, grab it from there, and that's just sort of how banks operate. Yeah, and that of course just creates, as I just mentioned, spillover channels to this broader financial system.
Yeah. There's another movie called "It's a Wonderful Life," old movie. It's about this banker that he's living through the recession, and when the recession hits, everybody comes to the bank, right? I want my money out before the bank, and so he has to tell them, like, look, we don't have your money. I mean, we have enough money for some of you, but we don't have all of your money just sitting there. Some of your money is tied up in Joe's house, and in Mary's business, and some of your money is set up in that building that went up with all those restaurants. It's kind of like, it starts to explaining to them how the money doesn't just sit there. There's not just a safe, where you can just deposit your money and have it sit there. Like, they're using it, and that's why they offer you a little bit of a percentage to put your money there. I'll give you 1% of your money because I'm going to use it to make 10% on it, right? I'm going to give you 5% on that, that CD long-term deposit, because I'm going to, sell it back to you at 20% on an interest card.
Yeah.
20% interest on a credit card,
Mhm.
right? So that's how money works.
Yeah, and that's just because banks, they have to make money somehow, since they don't really sell you anything, like a regular product per se. And
Banks are there to make money.
yes,
Like, make no mistake, they are there to make money. They're not a service, a nice thing that they want to do, keep his money safe. No, they're there to make money off of us in as many ways as they can.
Mhm. And as private credit enters 2026, they're facing its most challenging environment since the 2008 financial crisis, with cracks emerging in corporate credit and high-profile leveraged loan defaults in late 2025, and rising of use of payment in kind toggles in direct lending, pointing to mounting stress. And of course, this leads us to sort of the whole comparison that is being made by many people, which is the comparison to the 2008 real estate bubble, or I guess 2000, which led to the 2008 recession. And so, just to explain as a bit of background, in 2007, the financial system was hiding risk in off balance sheet vehicles called SIVs, structured investment vehicles. And these held mortgage backed securities, and banks created them to keep the debt off their books while retaining the economic exposure. Sound familiar?
Mm-hmm.
Citigroup actually caused mass banking contagion with its derivatives and off balance sheet structured investment vehicles in 2008. And the US Treasury actually had to inject $45 billion of taxpayer capital into Citigroup through TARP, which is, I believe, is short for Troubled Asset Relief Program. And this is important because that's just what's visible. And the full rescue was astronomically larger. And the real city bailout, the 45 billion from Treasury TARP, plus a government guarantee on over $300 billion in certain assets, plus 5.7 billion in FDIC guarantees on senior debt, plus another 26 billion in FDIC guarantees on commercial paper. And plus, this is one that the public's never heard about until a GAO audit in 2011. A $2.5 trillion in cumulative below market loans from the Federal Reserve between December 2007 and July 2010, trillion with a T, in one bank. Citigroup's market value went from 250 billion in 2006 to 20.5 billion in November of 2008, and it lost 87% of its value in a single year.
And that's only 20 billion.
Yeah.
Like, the swing that he created in the market with 20 billion.
Mm-hmm.
Now we're talking about one company, 200 billion, just one.
And the really crazy part is that until 2011, all everyone ever really heard about was the 45 billion from the Treasury TARP. But really, the Federal Reserve gave them about 2.5 trillion in cumulative below market loans, which means basically that they were getting almost 100 times 100 times what was really told, like what we were told initially, and under the table loans, I guess under the counter loans.
They just didn't have to tell anybody about it.
Yeah, they didn't tell anyone until someone did an audit and found that out themselves. So the SIV total, when forced onto Citi's balance sheet, was 59 billion, consolidated in December of 2007, and the off-balance sheet risk that became a balance sheet crisis overnight. And the core parallel to today, in 2007, it was mortgages hidden in SIVs, and in 2026, it is AI debtors hidden in SPVs. And the instrument is different, however, the structure is the same, and the BIS used the same word, quote, shadow, to describe both. And this sort of specific structural echo that we're hearing right now about this is in 2007, banks created off-balance sheet vehicles, mortgages went in, debt was issued against them, and the vehicles were connected back to banks through guarantees and credit lines. And when housing fell, the vehicles blew up. The guarantees were activated, and the debt came back onto the bank balance sheet as shock. And in 2026, companies create off-balance sheets, SPVs, data centers go in, that is issued against them, $27 billion, $38 billion, $18 billion at a time. The SPVs are connected back to tech companies through lease commitments and guarantees. Private credit funds hold the debt, and insurance companies and pension funds hold the private credit funds. If AI demand disappoints, the lease payment gets stressed, the SPV gets stressed, and shock will travel all the way down that chain.
That's pretty interesting. I think maybe some of the questions people would ask is, what's the difference between the leverage between, back in 2008 to the leverage now, right? Like, if you look at that comparison, and that might be something that paints a different picture for people, not necessarily to make us feel better, but maybe at least to help us understand where things stand.
Yeah, and this is sort of where the parallel breaks down. So, fund level leverage in private credit is moderate, around 1 to 1.5 times. Pre 2008 leverage was 30 to 40 times.
Wow.
This is not a small difference. The 2008 system was catastrophically more leveraged than what it actually exists today. Most private credit capital is locked up for years in closed-end funds rather than runnable demand for deposits. And there's no CDO style securitization chains of comparable scale. And a CDO is if I remember correctly, a credit collateral. I haven't seen The Big Short in a minute, so I wouldn't know.
I can't remember what it stands for.
CDO is a collateralized debt obligation, I believe.
Oh, okay, that makes sense. Sounds right.
Oh yeah, sad. That's what it is. A collateralized debt obligation. And if you've seen The Big Short, those caused quite a large amount of issues. But anyways, so yeah, there's not really any CDO style securitization or securities today. But through a small of growing private credit CLO market, about roughly 3% of assets represent an early move back towards this securitization model.
CLO?
CLO, yes.
Okay. What does that stand for?
That stands for a collateralized loan obligation. And that in the CLO just is a structured financial security, which is backed by a pool of corporate loans, usually loans made to companies with lower credit ratings, which is kind of similar as to what we saw from 2008, where
the subprime markets.
Yeah, the subprime markets, and they started filling these MBS, these mortgage-backed securities, with riskier and riskier loans with credit ratings around like C, double C, B, triple B.
Well, yeah, and I mean just they're also subprime because it's given to people with poor credit, right? 600 and below, which number one, it means that they either don't or don't have the ability to repay their debts, right? They just bad history on repaying their debts.
Yeah, or they had ninja loans, no income, no job loans, where they would just hand out loans to basically anyone who walked through the door.
Yeah, and so what happens is these subprime loans weren't, again, they weren't charity. They were higher interest rate loans because they go, well, it's a bigger risk, so we get to charge you more. And you should be grateful because you can get a mortgage now.
Yeah.
And so, again, either they don't, meaning that they won't, or they can't. They don't have the ability to repay their debts. And so now I'm putting you into a loan which with a higher percentage, which means you have a higher payment, which is more stress on your finances. So it's almost a self-fulfilling prophecy that I'm giving a loan to somebody that doesn't have the history of paying off their loans, but I'm also going to make it harder for them to pay their loans.
Yeah. And yeah, that's just essentially sort of, it's easy to see a lot of these similarities between then and now.
Yeah.
And we'll go through some of these.
The leverage thing does make it feel a little bit better.
Yeah.
The leverage is not quite the same.
Mm-hmm. And actually, JP Morgan's CEO, Jamie Dimon, he called the $1.8 trillion market still small enough to pose no significant threat. But Morgan Stanley CEO, Ted Pick, described it as a, quote, adolescent moment for a young asset class. And the Treasury Secretary, Bessent, he concurred that idea. And the people running the biggest financial institutions in America are publicly downplaying the risk. And the counter argument to the counter argument, they said similar things in 2006. The question isn't whether the system is identical to 2008, it's whether it shares enough of the structural features, hidden risk, opacity, interconnection, and leverage concentrated in institutions that cannot absorb these losses to produce a similar outcome at a different scale. And the BIS thinks that this question deserves an answer.
Yeah, I mean, at the end of it all, when there is opportunity for growth like this, there's also greed, and especially in the investment sector. Somebody's trying to figure out how do they monetize this thing the most, and that's not what was happening back in 2008. They figure out how to monetize the subprime loans, and so all of a sudden it's like they sold it as an asset, and then I sold it to you, you sold it to somebody else, and they sold it to somebody else. It was just a matter of time before you go, okay, who gets to hold the hot potato last, right? who gets left with the hot potato? The scary thing is that if enough investors get into it and start playing this game again, somebody's going to be left with the hot potato, but it's going to be worth, maybe even more financially, even more than it was in 2008.
And with all of that, there is sort of a return on investment problem, because another really important question to ask is, underneath all the spending and leveraging, will this actually work? And this is where it kind of all ties together. If the AI revenue doesn't materialize, the debt structure will become a crisis. And MIT found that roughly 95% of generative AI or AI pilots delivered no measurable profit impact. And the S&P Global found that 42% of companies abandoned most of their AI initiatives in 2025. IBM put the share of AI initiatives hitting expected ROI, or return on investment, at 25%. Morgan Stanley found that only about 21% of S&P 500 companies could point to measurable AI benefit at all.
That's scary.
Yeah, and that's actually kind of a fact that I think most people don't actually know, because most people they won't tell you this, because there's a lot of, I guess, hope and hype behind sort of.
Yeah, every time somebody makes videos, for social media, right? Videos of, like, I don't know, ducks playing the drums. It doesn't. I mean, it creates, right? It uses the AI, it uses the money that it takes to have that AI, but it doesn't turn into any kind of revenue for them.
Yeah,
it's just usage.
And unless that's your business, like a company like Higgsfield, where you can go in and like make very high quality generative AI content, it's really hard to kind of add that to what you already do and try and see a return from it.
Yeah.
And hyperscalers are on track to spend about $675 billion on AI infrastructure in 2026, which is up about 63% from that prior year.
Wow.
And what that spending has not built in most cases is any reliable way to know whether these tools are working in the broader corporate economy. And the most revealing moment was on April 29th of 2026. An analyst actually asked Meta CEO Mark Zuckerberg about ROI on Meta's $145 billion AI capex, or capital expenditures, which basically just means it's just like a
money spent.
Yeah. And he called it, quote, a very technical question. And then right after he did that, the stock dropped 6% after hours on a quarter, where revenue was up 33% and profits were up 61%. And Meta actually had its best quarter in years and still lost 6% of its value because the CEO couldn't explain what $145 billion of in AI spending was actually returning.
Yeah, that's how it should be, right? Like, you should be, a company should be punished for not being able to explain what it is that they're doing. You're getting money from the public, you're getting money from the institutions. Again, somebody's putting money into Meta, and they're taking your money. You get into the institution, they're putting it into Meta, and Meta goes, yeah, we got 200 billion, right? We got $200 billion last year from these investors, but 140 billion of that, we don't know how we used it. But yeah, you should be immediately punished for saying something like that.
And actually, 61% of CEOs are saying that they're under increasing pressure to serve returns on their AI investments compared with a year ago. And reports say that 95% of AI pilots generate zero return. Boards and executives are understandably going to ask tougher questions, because, usually boards consist of shareholders, and these shareholders have massive stakes in these companies, and they want to know what's going on with the money they're investing,
Yeah.
or the money that's coming in to these companies, and how they're using it. Because if they're using it poorly, it tanks their stock price. These shareholders on these boards are going to feel it the most, because they're on the board because they hold enormous stakes of equity in these companies. And all of this is going to create structural danger, where the entire private credit edifice described above, the $30 billion Meta deal and the $38 billion Oracle deal, the 80 billion that Morgan Stanley projects will be needed by 2028 is predicated on AI revenue materializing to service this debt. And if this revenue doesn't come, the lease payments become stressed. And stressed lease payments means stressed SPV debt. And stressed SPV debt is going to mean losses at private credit firms. And these losses at private credit firms means losses at pension funds and insurance companies. At that point, the question stops being about technology and starts being about financial stability.
Yeah, again, the mighty domino that everybody understands, everybody listens to their gut, they feel it. I feel like companies are putting a lot of money, so a lot of eggs in one basket, right?
Mhm.
The AI basket, and just like people are putting a lot of eggs into certain real estate investments back in 2008. Yeah, that one domino can take down a lot of things. So.
Mhm.
But but here's a question though, like cash flow, right? So supposedly these companies are making cash flow,
Mhm.
which is maybe something that separates them from like the .com era where there was no value created. It was just speculating, right?
Yeah.
Oh, we think pet.com is going to be great. It's like, no, it wasn't. It's like, no, great idea, poor timing, right? Like Chewy is trying, like what Chewy does now is what pet.com wanted to do.
Yeah.
And so it's like same idea, it's just wrong timing, right?
Mhm.
But the thing is, back then it wasn't a good idea. Like the market wasn't ready for it, the infrastructure wasn't ready for that. And so people were throwing money at companies, all these internet businesses without really knowing if it's going to work. Now these companies actually do make money.
Mm-hmm. And that's something that's very important to mention, because a lot of times when people who are more bearish, or they try and make this 2000 or 2001 comparison to the .com bubble, it doesn't quite work as well as the comparison than with 2008. Because in 2001, a lot of these companies like Pet.com or Cisco, their share price was way above what their earnings per share actually was. So if you look at it on a line graph, for example, you'd have Cisco all the way up here and their earnings per share like right here. So essentially way overvaluing a lot of these companies. And the difference today is that companies like Nvidia, you will see their price is like around here, but their earnings per share will actually be about around here. So they either cross or intersect, or they'll be at the exact same level.
Mm-hmm.
So the .com bubble isn't really the best comparison to use in this situation, if that makes sense.
Yeah, it does. And so what would you say though, as far as like they being able to service the debt easily? Because they are making money.
Yeah, they do have really good cash flow, but Microsoft, Meta, and Alphabet are expected to see free cash flows drop by roughly 90% in 2026 as these capital expenditures surge. And this cash flow story is already being pressured by the spending itself. And the debt being discussed isn't really on their balance sheets. It's going to be in SPVs, where this cash flow is the lease payment. And if these companies have a bad quarter and decides to renegotiate their leases, the SPV's debt service is going to be suddenly in question.
Yeah, that's interesting. And so, yeah, and that's when the government, so something happens, they crash or whatever. Like, would the government step in to save them, or save everybody again? Because that's going to happen in 2008 too,
Mhm.
with like the car industry. These companies were just too big to let them fail. They were too big for capitalism to do what capitalism does, right?
Yeah.
Which capitalism would have said, yeah, you messed up, you're out.
Yeah.
But they were just too big to let them fail. So the government stepped in and bail them out again. $700 billion just like one company, I believe, like Ford or something like that in Chrysler. And so they stepped in and saved them. Like, is the government going to do the same this year? Or could they, or this time, or could they do the same?
Well, the difference now is that there's post 2008 regulatory framework, but that framework specifically applies to banks. And private credit funds, of course, are not banks. They are not subject to the same capital requirements, stress tests, or even resolution frameworks. And the FSB and BIS, the sort of two large centralist banks, their warnings specifically note that this regulatory gap, if a major private credit fund blows up, the tools to contain it are going to be significantly less developed than if for those that exist for these banks.
Okay, fair enough.
Indeed.
Well, that's how capitalism works, right? Some take the risk, and some, whoever takes the risk should make the most money, I suppose. But what happens when they don't? Right? That's a big question.
Yeah. But in 2007, the bet was on housing, and in 2026, the bet is on AI. The asset is different, but the structure hiding the bet looks the exact same. And the people who pay if it blows up, they're not the ones who actually made the bet. So, with that being said, of course, the question of whether we are in the midst of an AI bubble or an AI boom that will keep moving is going to be the question at the end of the day. Because of course, while these numbers are very damning, of course, nothing's ever confirmed. We can't really say AI demand is going to disappoint because AI does seem to be growing very fast. But of course, you also have these counter arguments to saying where AI is not quite showing up to be as profitable in their returns as expected. So, of course, the idea, if we're in the midst of an AI bubble, is for you to decide. There's a lot of good arguments for it, and there's a lot of arguments against it. And whether you believe that it is a bubble or not is for you to decide, as we always say. So, yeah, that is the show that we had planned today here on Saber. I'd like to thank my dad for being here on this show. And of course, it is Father's Day, so happy Father's Day.
Thank you. Thank you very much. Thank you for having me. I'm mega proud of you for everything that you're doing and for the good that you're doing to the world. And just to echo what he always says, it's important to be informed. Education is a gateway to many, many things, but if anything, is the gateway for you to take power and to take ownership of your own life. So don't ever underestimate the power of knowledge and the power of good education. So is there a bubble? I don't know, but you know what? I know more now than I did yesterday, and so in the future I can make better decisions. There's a lot of ethics that go into this as well. But I feel like I'm a little bit better prepared to, to vote for legislature, right, and get behind people that are right in the legislature to maybe put the reins on this. So if it does pose a risk, the risk can be mitigated. So, anyways, so thanks for doing all this.
Yeah, of course. And I couldn't have done it without him, right? He's the one who got me here on this world to at least do this in the first place. So, of course, thank you, Dad, for doing everything you do. Thank you. Of course, having the roof over my head in which I produce all this news and all this content. And yeah, so thank you for everyone for watching the stream. We'll be back here on the air likely tomorrow on Digital Newsroom. We are going through some infrastructure changes at Saber, so we'll see about tomorrow. It'll be on the Instagram at sabernewsofficial.com, whether or not we will be live on Digital Newsroom tomorrow. With that being said, thank you for everyone for watching. My name is Elijah Ireta. I'm the editor-in-chief here at Saber News and its founder. And remember, this is always all for you to decide. It is important to stay informed, and it is important to stay smart, because if you are smart and informed, you are unstoppable in the world. So yeah, thank you everyone for watching, and yeah, happy Father's Day, everyone.
Happy Father's Day.